Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. every Monday morning. Get you ready for the week with the stocks I'm watching, the economic news you need to see, and what a week it's going to be, right? After 2 weeks of stocks falling, Chair Powell came out last week, spooked the markets with what is really kind of a delusional stance of what their Fed rate hikes are going to do to the economy. We're going to talk about that. Stick around, though, because after that, I'm going to show you the stocks I'm watching this week and the economic news that you need to see. I do want to get to Chair Powell, though, because as bad as 2022 was for investors, we could be in for yet more pain in 2023, just because of how delusional Chairman Jay Powell and the rest of the Fed is about this economy. And delusion seems to be a common illness with Powell and the Fed, so common they might be more comfortable in straitjackets than business suits. Here we are on the Fed's Consumer Price Index, that CPI report, that measure of inflation. And last year, over the past few years, it's been stuck really at 2%. Last year, they were saying that this inflation was only going to be transitory as it was creeping up. We were here on the channel saying, no, you're going to get much more inflation because they're just pumping all that money into the economy. Then consumer prices surged up to 9% here in June, and the Fed was caught off guard. Even with that inflation coming down over the last month, it has been a long way from transitory, from temporary that the Fed said it was going to be last year. Now Powell and his colleagues seem to be delusional about their own forecasts, the record-breaking speed of interest rate hikes, and what it's going to do to the economy. For example, last year, the Fed told the stock markets, told investors that it expected to raise rates less than 1% this year, that transitory inflation wasn't going to be a problem. They wouldn't need to raise rates so much, and they were going to raise rates by about 0.87%. They have now raised rates by more than 4%, the fastest pace in more than 40 years. This is a chart by Visual Capitalist here. It shows the hike cycles by the Fed over the past 40 years. You've got the 2022 one circled, and then you've got 88, 89, 94, 95 here in green. A little bit darker green is the 2004 to 2006 cycle, 99 to 2000, and then the 2015 to 2018 cycle. These are 5 other interest rate cycles by the Fed, how quickly they increased rates and how long it took them, months after that hiking cycle started. So when they first initially started raising rates to slow down the economy, to slow down inflation, how slowly they went on raising rates and how far they went. And you can see most of these. So from 1999 to 2000, they only raised rates by 1.5%, and it took them 10 months to do it. Here in 2015 through 2018, they raised rates by about 2%. It took them 35 months, almost 3 years to raise rates just 2%. And even in 2004 to 2006, when they were trying to slow down that housing market bubble, trying to slow down home prices and inflation, they did increase rates by about 4%. But it took them almost 2 years. It took them more than 2 years to raise those rates, that 4%. Here we are in 2022, and this chart is even a little bit outdated because they've already raised rates up here to 4%, just under 4%. They've raised rates, and it has taken them only about 10 months. It has taken them 10 months to raise rates 2%. That is by far the fastest they've raised rates in the past 40 years. And the problem with this is, folks, that if raising interest rates slows down the economy, that's the whole function. That's the whole thing that the Fed is trying to do. It's trying to slow down the economy, slow down that inflation, slow down consumer spending, and increase the unemployment in the market to slow down the economy. The problem is when you do raise rates, it takes a while for the economy to adjust to that fact, to slow down. But they're not waiting to do that. They're raising rates by the fastest they've done in 40 years, wondering why inflation isn't coming down faster than it is, because they haven't given it enough time. And where I say the Fed is delusional here is in its own projections, its own economic projections about the economy over the next couple of years. This here is the economic projections of the Federal Reserve Board, the Federal Reserve Bank, on monetary conditions. They put this out there. They update this constantly to give the market an idea of what they're looking at for the economy, what their projections are for the economy, and why they're raising rates how they are, or maybe even lowering them when the economy falls. They just updated this December 2022, just this last Wednesday, when they increased interest rates. And I've highlighted the 3 most important lines here for you. For the overall economy, this real GDP, change in real GDP, the Fed sees the economy growing from 0.5% pace this year to just a 0.5% pace next year. So that would still be economic growth. The Fed does not see the economy falling into a recession on their scenarios. The problem is the Fed also expects the unemployment rate here, this next one, to jump from 3.7% to 4.6%. So almost a full percentage increase in unemployment. And on the Fed's own projection, according to the labor force, that would mean an additional 1.6 million Americans out of work. Even at the press conference after the meeting, Chair Powell was asked about this, asked about whether this would cause a recession, and he came directly out and said, I don't think this would qualify as a recession because you've got positive growth, okay? Again, the Fed is still projecting 0.5% growth in GDP, positive growth next year. They're saying there's not going to be a recession, but of course, Wall Street and just the stock market in general was quick to call bullshit on this, on Powell's optimism, on the Fed's optimism. Ryan Sweet of Oxford Economics even came right out and pointed out that that level of an increase in the unemployment rate has never happened without the economy falling into a recession. Okay, you have never gotten unemployment to rise by almost 1%, almost a full percent, 1.6 million more Americans out of a job without causing a recession. Okay, that many Americans, that many people all suddenly in a year out of a job, that has effects on consumer spending. Consumers are going to spend less if they've lost their job or if they're worried about losing their job. Okay, and since consumer spending, the consumer side of the economy is 70% of the economy, that is going to cause a recession. It is almost inevitable at this point. This third line here, PCE inflation, personal consumptions expenditures, the PCE report. This is actually the preferred measure of inflation by the Fed, the inflation report that the Fed watches to adjust its rate hikes. And here we see that this is averaged about 5.6% for 2022. The Fed, in its projections, expects this to drop to 3.1%. So the Fed does believe it is going to win its fight against inflation, drop inflation by almost 2% in just 1 year. Now that is a big drop, especially considering that PCE inflation has only dropped by about 0.4%, less than 0.5% from the peak in February. So from that peak in inflation in February in this report, it's only dropped 0.5%. Now the Fed is telling us, or trying to tell us, that they think it is going to drop by another 2% by the end of next year. That is not going to happen without what Powell, in his own words, is calling some economic pain. So it is very, very difficult to see how we get that kind of economic pain that drops inflation by 2% without a recession. Now, what that means for stocks and how to invest in that with that still high inflation rate, it probably means the Fed won't be able to come to the rescue for the economy as we start seeing unemployment increase, as we start seeing the economic growth slow down, even in a negative territory, even into a recession. Okay, the Fed has that long-term goal of 2% inflation. It is not going to be able to start cutting interest rates until we get much closer to that. Even by its own projections, it will only hit 3% next year, that inflation. And that's probably a long shot. It might not even come down to 3% next year. That idea of a Fed pivot where the central bank does pause its rate hikes and starts talking about cuts may not come next year in 2023. The Fed has slowed down its interest rate hikes just this last week. It only raised rates by 0.5%. It had been raising rates much faster before then. It started raising rates by 0.5% this last week. The market still expects the Fed to raise rates by another 0.5% when it meets in February, but then to pause altogether, to stop raising interest rates. And then the next hope would be that they start cutting interest rates when the economy falls into a recession and when people start losing their jobs. But again, that might not be possible if inflation is still high, as the Fed expects. And that Fed pivot idea is what has caused stocks to go a 15% bounce higher from the October low. Okay, mid-October, about October 13th, the S&P 500 did hit 3,500. That was about 28% down for the year. The stock market has rebounded 15% this year, or so far since that point. Even though it has given back about 5% over the past couple of weeks. Now that Powell and the Fed, though, have thrown cold water on that pivot idea, saying that inflation is only going to come down to about 3% next year. We are going to see some unemployment growth, but they don't see that pushing us into a recession. The Fed is just delusional and probably not going to be cutting interest rates or even talking about cutting interest rates anywhere near what the market expects. In this kind of an economic environment where there's so much economic uncertainty, where stocks hit lows, they bounce back up, and then they fall again. We've talked about this on the channel before. I'm using the barbell strategy. We've talked about this. Think of a barbell with all the weight on two sides at the extremes, nothing in the middle here, but all your weight at the extremes here. This is where you have half half of your portfolio in those beaten down growth stocks, okay? Those stocks that were making everyone rich during the pandemic, those growth companies growing sales by 10, 15, 20% a year, really changing our lives in those growth industries. You have got to have a position in some of those, because those are going to rebound as we bounce back up from those lows, right? In that growth environment, when the economy does start growing once again, those stocks are really going to jump higher, faster than the rest of the market. But you also want the other half of your portfolio in those cash-like safety assets, right? Those short-term bonds, that cash itself, are giving you the opportunity to buy back into stocks as they hit those lows. So you're kind of playing both sides here, and you're getting the best of both worlds, okay? If the economy does take off, if we don't fall into a recession, which I think is a very low probability event, but if we don't fall into a recession, if the stock market does jump higher in 2023, you're going to benefit with those growth stocks in your portfolio. Those are going to bounce back up off of the depressed lows that they are this year. If on the other hand we do hit fresh lows, even if the market just comes down a little bit more and gives back some of that rally, which I expect it will on that delusional Fed and Chair Powell, then you've got that cash. You've got that cash set aside to take advantage of those lower prices and buy in when you can there. Click on the video to the right for the 9 stocks that could save your life. 9 stocks to buy and one of the weirdest stock market videos you will ever see. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.